What are we here to talk about today, Dulce?
Debt-free life.
Right on. And what do you know about debt-free life?
Um, I know that you can make your money work in a certain way, so that way you cash out at the right time when you're a little bit older.
Okay. What if you don't want to cash out?
You don't have to. You can leave it for the next generation and then
Right
the
on.
next
There's all
generation.
kinds of stuff you can do with them. Right on. Didn't mean to put you on the spot, but I want to put somebody on the spot. All right. So, hi, my name is Michael Scott Forehand. Today is January the 30th, 2025. It is 5:36 p.m. We are here for the monthly Debt-Free Life Infinite Banking class. We're going to start with a 30-minute presentation. This is using the same slides that I typically use, but usually the verbiage changes around some each time. And then we're going to open it up for Q&A. I don't have any guest here today um, because I forgot to ask somebody. So we'll do it next time. Anyway, I'm going to go ahead and share my screen and we'll get started. Ding! You should see my screen now. I see some affirmative head nods. Right on. All right. So, what is Debt Free Life? So, Debt Free Life is a proprietary program that belongs to Symmetry Financial Group. It is a tool or a system, if you will, that utilizes specific kinds of cash value life insurance programs to help people eliminate debt in a manner that works faster than most people can do. For example, if you have one debt, that's easy. There's only one order to pay it off. If you have two debts, A, B, then you can pay off debt A first and then B, or B first and then A. So there's really only two calculations. Once you get to that third debt, though, now we've got a problem. So it can be debt ABC, debt ACB, debt BAC, debt BCA, or debt CAB, or debt CBA. So when you get to that third, that's when we start looking at an exponential increase every time and the number of permutations or orders in which you can pay off the debt, which is why the software that we use and the solutions that we have available to us and the debt-free life solution are so unique and so powerful because it is I've done the math on someone that had only five debts, and it took me about 8 hours to do all the math using some pretty advanced spreadsheets to figure out what was the best order. And I'm not doing it again. I'm never going to do that math again. So that's why we have the software available to us. All right, so that's debt-free life. Debt-free life is a play on words. You have debt, and we're using a life insurance policy to eliminate the debt. Debt-free life. Plus, you want to live a debt-free life. If I'm having, let's say I make $100,000 a year in retirement, but $40,000 a year is being used for debt service, that means my net, my living, my cash flow is really only $60,000. But if I have a $70,000 per year income and no debt, then I'm actually much better off. I'm going to be 12, 13% better cash flow simply because I don't have debt service. So whenever we look at these debt-free life programs, our goal is to eliminate debt in a strategy that's quicker than what we do normally, and that we can capitalize later on, like what Dulce was saying in the very beginning of this conversation, capitalize on that later on, how her words were cash out. What I like to think of it is I can take a distribution and I can take a permanent distribution that, depending on the structure of how we take the distribution, it can be a tax exempt distribution. So the other thing that I really like about these debt-free life programs is that when you're using them in a retirement situation, I don't have a specific period of time that I have to take the money. There's no such thing as an RMD. And I don't have a specific minimum age I have to get to before I can touch the money. There's no minimum retirement. I don't have to be 55 or 59 and a half or 62 or whatever year the IRS decides it's okay for us to retire. All right. So when we're first looking at these programs, we're taught as broker underwriters that do these programs, we're taught to ask pretty much two simple questions. And to paraphrase, are you 100% certain you're going to have a solid retirement? Do you have some doubt? Or if we could show you a way to get out of your debt in 7 to 9 years, would you be interested in listening? Now, that last one about the debt, the reality is, and I've done literally, I've planned thousands of programs, and the reality is, it's not 7 to 9 years. The real number, it's 15 to 27 years early. So if I have a 30-year mortgage plus six other debts, I'm not going to get out of debt tomorrow, but it's very likely, depending on the nature of those debts and how I'm overfunding, I can probably do it in less than 7 years. So, excuse me. So it's 15 to 27 years early is what I see. All right. If you're like most Americans, this kind of represents your cash flow. This is not the way it was supposed to be. If you went back to 150 years ago, there was no such thing as income tax. Okay, so what we're talking about here is there's too much tax, we're borrowing too much money, and the national debt at 36 trillion, that's a testament to how much we're over borrowing. And we're not spending or saving money inefficiently or efficiently. So that's what the debt-free life program is designed to do. It's designed to fix those three problems: reduce the amount of taxes we're going to pay, increase the amount of money we're going to have for retirement, and decrease the amount of interest we're going to pay over time. And if you can do the reduced taxes and the reduced interest, that makes money for the increased retirement. Notice in that whole conversation, I never said go out and get a job and make more money. So we don't have to go out and make more money. We just have to spend or save our money more efficiently. All right. So the average American, this is old. This slide's about 6 years old. The average American makes about $2 million in their lifetime. That number's higher now. And the average American, unfortunately, only has about 3% of their annual income as a retirement. And if we're talking about having 3% of our $2 million of annual income, that's only about 60,000 bucks. If you're making $100,000 a year and then all of a sudden you only have $60,000 saved for retirement, you better hope Social Security stays around and is getting raises faster, because it's not going to work, right? So that's what we try to do here. We try to fix that. We don't want to rely on Social Security. None of us, I think if you talk to anybody on the street, especially, Gen X and Gen Zs, they don't think that Social Security is going to be around when they're able to get Social Security. And I don't disagree with them. Um, this is when you approach somebody who is a debt manager or a debt consolidator or a debt negotiator, and you come to them with a debt load that's becoming unserviceable. These are the things that they're going to tell you to do to go out and get out of debt. In and of itself, each item is it might work. None of them are, it will definitely work. So what you're doing is you're throwing stuff up against the wall and see what might work. The problem with that is that, and this is goes back to financial planning, you're hoping something works. You have a hope, and hope is a really, really bad financial plan. I hope I have enough money for retirement. I hope I don't outlive my money. I hope my house doesn't get foreclosed on. I hope my wife doesn't have to go live with her parents or her sister when I'm passed. So hope is a bad plan. And this is a tool that we use to make sure that we're not relying on hope. All right. So where you are most likely, if this is the first time you've been to one of these presentations, is you're on the left side of my screen, and you are spending an inordinate amount of money, about 74% of your annual income. You're spending that much on taxes and interest, and you're only saving about 3% of your money for retirement, and you're struggling with the remaining 23% to live life, to pay the power bill, gas bill, water bill, to put food on the table, to go maybe take that one trip with your family, maybe go to Disney World. Maybe your entertainment consists of just Hulu or whatever. it is unfortunate, but that's where a lot of people are these days. And what we're going to try to do for you is move you to the right side of the screen. And the way we do that is by looking at everything you do, not just life insurance. Where do you spend money? How do you spend money? What do you spend money on? How do you save money? What kind of return are you getting on the money that you save? Do you have a retirement program, a 401k, a 403b, a TSP? Are you getting matched by putting the money in there? And I would say if you're not getting a match, it's a bad way to set retirement. So so that's kind of what we do. We look at places where you're spending or saving money inefficiently. The primary places where we see that are you're spending too much money for inefficient life insurance. You're saving money into savings accounts, which have notoriously low yields, or you're saving money into a retirement program that's not matched or is not performing. You're saving money because you don't trust banks in the coffee can in your backyard or in the safe underneath your bed. These are all inefficient ways to save or spend money. And one of the critical things that we see here is, people that end up running up some credit card debt, their thought process, rightly so, is that I'm just going to pay a little bit more on these debts to get them paid off faster. And that on the surface makes sense, because if I'm paying some more principal down, then I'm saving the downline interest. But the problem is that money you're only spending it one time. And this is a difficult concept for people that aren't familiar with infinite banking to get their head wrapped around. I don't have to spend my dollar only one time. And that's the idea. I want to recycle my dollar. I want to spend it more than once. I want to spend it three times, four times, five times. And when I spend it, here's the kicker. And I'll show you this in a minute. When I spend it, I want it still to be working for me, even though I spent it. What? Yep, that's what I said. I want that dollar that I just spent to still be working for me, even though I spent it. And that's kind of the really the magic, the secret sauce with these programs. It's the only investment, if you want to call life insurance an investment, it's the only investment of its kind on the planet where you can earn money and spend it at the same time. And I'll show you how that works in just a minute. Yeah, I know, too hard to that's too good to be true, right? Yep. Well, we'll prove it to you. All right. So this is what we do. And this addresses some of those things I just spoke of. We're going to eliminate your debt quickly. If I eliminate your 30 years of scheduled debt in 9 years, then I just saved you 21 years of scheduled interest. And that's 21 years of interest. You're going to be making the same money. And if you assume that you'd be spending the same money, now we can spend it towards your future. We can put the money to work for you. And if we're using the rule of 72 as an investment strategy and we're able to engineer 4, 5, 6% return, that means we can double that money every 10, 12 years, which is great. Even better, because we're doing it in one of these programs, not only are we doubling it, we're doubling it in a tax exempt manner. So in this example, if I have $100,000 that I'm going to build over time, and I'm going to build it into a program that's earning, let's say, an average of 4.5% per year, and then I have another program where I have $100,000, and I'm going to earn the standard S&P rate of return of 5.9% per year, which one's better? Well, I would say that the 4.75% is way better because if I'm in a program that's going to earn or gain in the S&P, most likely I'm in a taxed environment. So, yep, I'm earning 5.9%, but I'm also going to be paying 22, 23, maybe 32% of that in taxes, depending on when I take the money out and when I realize the gain. In our program, the interest is guaranteed and there's no tax because we're not doing it in a tax exposed environment. And that's one of the really cool things, one of the key things about infinite banks. So we're going to reduce the amount of taxes you pay over time simply because if I'm investing in a tax exempt program versus a taxable program, then the taxable program is going to underperform. And that's what this next slide should be about. Actually, it's not. But this slide is. This is the what happens when you invest a certain amount of money in a taxable where they tax the gain or a tax exempt where the gain isn't taxed environment. And that's really this argument is simply what's a tax exempt environment? Roth is one. All infinite banks, if they're structured correctly, should be tax exempt. That's another. That's about it. Okay. What's a taxable 401k, 403b, TSP, KEO, SEP, FERS? All these are taxable retirement systems. And the gain that you get in there, oh, look, I made 10% this year. That's fantastic. What did you make last year? Oh, I lost 8. Okay. In my tax exempt program, that's a Roth. What did you make this year? I made 10%. What did you make last year? I lost 8. In the tax exempt program that is built on life insurance, cash value life insurance, what'd you make this year? I only made 4.5%. What'd you make last year? Everybody else seems to have lost money. Yeah, I made 4.5%. So that's where the rubber meets the road, folks. When you compare these programs side by side in a taxable versus tax exempt, in a at risk program like a 401, 403 versus a no risk like an infinite bank participating whole life, it only takes 1 year for there to be a big downturn in the market. It is January 2025. Anybody remember what happened 2 years ago in 2022? Market lost 19.6%. And then the next year it came back with a vengeance, 16.2%. Didn't come back all the way, not even close. So this is actually, I think that was a year earlier now. So we're talking 3 years away from now. So there will be years where you're going to see a massive reduction in the growth or a massive reduction or pullback for anybody that's invested in equities. And that's where these programs shine. It doesn't, over a 20-year period, there's going to be 3 years of those 20 years. If you're invested in equities, there's going to be 3 years where there's a significant double-digit drop. And then it takes a couple of years for that to recover. If we're the snail, the slow and steady snail, like this is the tortoise and the hare race, right? That slow and steady wins the race. It's true. And if you run the math like I have over a 20-year run with those standard 3 years of drops, whether or not the equity invested position comes out ahead is entirely based on timing. And anybody who's worth their salt will tell you you can't time the market. So don't. Put your money on autopilot, put it in Infinite Bank. All right. An Infinite Bank is a financial instrument. It works like all financial instruments. It works in phases. Maximization, accumulation, distribution. The maximization phase is that period of time when you start the program and you're building up with however much more and more and more you can put in. It's not a level progression. It's usually a hockey stick progression, then it levels off. So you'll put a little bit more next year in than you put this year. And then the next year a little bit more, and next year a little bit more, and so on. That's maximization. Accumulation is when we've reached the pinnacle of how much money we're going to be putting in the program. I have reached the max. I'm going to retire in 10 years. I'm making $220,000 a year. I am willing to put 20% of my income into my retirement. If you have a bunch of debt, you might be willing to do that, but you can't afford to do that. So that's why it's so important as quickly as we can to eliminate debt, which is why this program is so powerful. And finally, distribution. Distribution, that's when you can use the money for whatever you want to use it for, whenever you want to use it. So if I'm 40 and I want to retire at 55 and I don't have a Roth that's been set up for 20 years, I got a problem. Okay. If I put it into a 401k, I can't touch it until I'm in my 60s. If I put it into a Roth, the earliest I could touch it is 55, and if it's been in there for at least 5 years, which means that 15-year window from 40 to 55, I'm hoping I don't have two of those drops, where you lose a massive amount of money, goes way down, and it takes a couple years to come back. Because if I got two of those drops in that 15-year period, I'm not gonna win. I'm gonna have less money in that program than I would if I'd done the standard participating whole life. And that's the logic about why these programs are so strong. All right, let's move on. This is not new. These programs have been around for a long time. And a couple of people that you see on your screen, Walt Disney, Doris Christopher, Ray Kroc, even Buffett. These are people that have utilized infinite banks over the years. They may not have been called infinite banks. That name was coined in the 1960s by Nelson Nash. First person that did this program was Rockefeller. He wasn't thinking this way. This is just a tool. It's a tool to eliminate debt. So it can do other things like what we've talked about, tax-free retirement. It can do legacy wealth creation, legacy transfer. There's a lot of stuff it can do. All right. But what we're talking about here today is primarily designed for debt elimination. All right. And this is just a summary of what we do with this program. One of the key things to know about these programs, actually, it's two. It depends on who's doing the program. So if you're an individual, then what we're really trying to do is take advantage of what's it's known as tax code 7702A, which talks about life insurance and the cash value of life insurance and the taxable or non-taxable nature of life insurance. And it's really based on the amount of money you're spending in premium for death benefit, which translates loosely to the amount of death benefit you have versus the amount of cash value you have. As an example, if you have a program that has a death benefit of $100,000, but you've got $120,000 in there, it's most likely a taxable program, a MEC, a modified endowment contract. If you've got a program that's got $1 million of death benefit and you've got $100,000 of cash value in there, it's very likely that it's a tax exempt program that is compliant with tax code 7702A. And it is observed by the IRS not to be a modified endowment contract. So part of that is going to be you can influence whether something becomes a MEC or not, modified endowment contract. Unfortunately, once you cross the line, you cross the line. A MEC's a MEC's a MEC. So the idea is that we want to, when we structure these, we want to put the money in there at a rate that gets us real close to that line. But we don't want to cross the line ever. We want to stay on the non-taxable side. And these other things that you see on your screen, these other bullet points, these are all tenets of the program, things that the program can do for you, and things that, while we do these things, are going to be ultimately impact your financial future in the long run. What's going to happen to your retirement? When can you take the money? How much can you take? So in your typical retirement, like an annuity program, there's a limitation while the contract is still in its surrender period. There's a limitation how much money you can take. In your Roth, there's no limitation. Take it all if you're eligible to take it. In your traditional IRA, if you're able to retire, you can touch it. You don't want to because you haven't paid tax on that yet. And that's the other thing. There's a reluctance to take money from retirement programs that are taxable. Because if I want to make $30,000 this year from my retirement program, I've got to take 43 to be able to pocket and use 30. And Uncle Sam is thanking you every time you do that. And if you don't want to do that, they don't care. At 73, you're doing it anyway. So that's I'm going to quote Ted Brenna, the guy that invented the 401k. He says he invented the 401k to do a certain thing. The rules and regulations that were in place at that time allowed that certain thing to be done. The rules and regulations have changed. Taxes have changed. Interest returns have changed. And at this point, a 401k is not the answer. And he says you shouldn't be doing 401ks unless you're getting a match. And that's where, that's part of what we do as planners. We start asking those questions. Okay, how much money are you putting into your 401k? $1,000 a month. Okay, how much are they matching you? $300 a month. How much of it do you have to put in to be able to earn that $300 a month? 300. So you're overfunding your 401k by $700 a month in that example. Yep. Why? Because I'm trying to play catch up. Wrong answer. That's the mistake. That's unfortunately, the common mistake. All right, so let's keep going here. This is just a little quick history of some of the folks. This, again, this slide is very old. This is 6 years old. These are some of the first families that we helped with this program and what we were able to do for those folks. These numbers are tiny compared to what we're doing now. It is, I will, it's not uncommon for me to see that we're saving somebody two or $300,000 in interest over time. And that's a beautiful thing because where's that money going? It's going right in their retirement pocket. It's awesome. All right. So I want to show you how you spend money. Now, let me preface this with one quick statement. You spend money the way you were taught how to spend money. And the people that taught you how to spend money ultimately were the banks. And the banks taught you how to spend money in a way that's most advantageous for them. They make it real easy to get into debt. How many people have a high credit score? How many people get offers every day for new credit cards? How many people have a high credit score because they don't use credit cards, right? The other is also true. How many people are behind on bills? How many people wish they had a credit card? How many people can't get a credit card because they have a problem with their finances? So when you don't need it, they want to give it to you. When you do need it, they don't want to touch you, right? So what I say is learning is half the battle. Learning how you spend money and then knowing the alternative, that's how you win the game. So here's how you spend money. So every day Dulce goes to work. She puts her head down. She helps a lot of families, makes some money. Money gets deposited into her checking account. She banks at Wells Fargo because Wells Fargo is a big name. It's a safe bank. And every year, Wells Fargo thanks her because for every dollar she puts into Wells Fargo gets to lend that dollar out every night. And they make money hand over fist with your money. The average dollar you put into your bank makes your bank 61 cents, whether you put into a checking account or savings account. So their goal is to get you to deposit as much money into your account as possible because they get to use it and lend it. And then eventually, Miss Dulce gets the opportunity, I'm going to pay my car off. So she tells her bank, hey, go ahead and pay my car off. And her bank, as they should, sends the money to her creditor. And now all of a sudden, where's Dulce's money? It's gone. Who's got it? Well, the creditor has it. And Dulce is a sweet person. And she's very nice and she's very comfortable on the phone. And she can talk to those people that now have her money. And she can be super sweet and say, hey, look, I've got kids at home. My husband's out of work. I need that money back. I need to pay some bills. And no matter how sweet she is, no matter how good her story is, they're not giving the money back. That money's gone. That money is no longer her money. It's their money. Okay. That's how we spend money. That we spend money to the benefit of the bank. Here's how you should be spending money. This is a debt-free life program. Now, Dulce did things the way that she did because Dulce was taught that way. Scott Simpkin understands what an infinite bank is, and he knows how to do that. So he does the same thing that Dulce does. Scott's a very nice young man. He goes out and helps families all day long, protects families, makes a good living doing it. That money gets deposited into his regular checking account just like a normal. That regular checking account, here's where the rubber meets the road. This is where an infinite bank stands in between the bank and your money. So as the money hits my regular checking account or Scott's regular checking account, you have the same name. I'll call it my checking account. As the bank hits Scott's checking account, Scott sends a payment off to his life insurance company. Now that life insurance program is structured as what's called a participating whole life. Participating means that the money that you put in there, a portion of it gets to participate with the profits of the company, and they pay you a fee to use your money. Does your bank pay you anything to use your money? Nope. So, so in this case, the company we've got our life insurance policy is going to pay us a premium to use our money. But What if we don't want to just put a little money in there? What if we want to put a lot of money in there? In order to maintain compliance with tax code 7702A, we have to have a large death benefit. The way we create the large death benefit is not through whole life, it's through a term rider. So we create a term rider that's usually somewhere between 10 and 12 times the size of the whole life policy. That creates, if it's $100,000 of whole life, that means we're creating about $1.1 million of death benefit. Not bad. Okay. That means we can grow a lot of money underneath there before the cash value is going to exceed the total death benefit. That's why we add the term. That's what it does. And we maintain the non-tax nature of the program by doing it that way. Now, what happens if that represents only about, let's say, 35% of the $1,000 that I'm spending a month with this thing? Well, that other $600, that's going to a different kind of life insurance called paid up additions. Let me explain what that really is. A paid up addition is paid up additional life insurance. It is an asset. Banks love them. Wells Fargo, $23 billion. PNC Bank, $19.6 billion. Heinz, $12.4 billion. Large corporations buy life insurance, especially paid up life insurance, and it becomes what's called bank owned life insurance. And they put that on their books. So if I'm somebody who's got a $100,000 life insurance policy, it's fully paid up, and I'm sick, and I don't know if I'm going to live a month or a year, but I've got the $100,000 of cash in this program and I can't do anything with it, or a death benefit that I can't touch until I die. Along comes a viatical settlement company. And they say, hey, look, Mr. Sick Person, you've got $100,000 life insurance. We know you're going to pass. You know you're going to pass. It might be a month. It might be 2 years. I don't know. But I tell you what, it's worth $100,000 when you pass. We'll go ahead and give you 5,000 right now. And so the guy does it. And then the company, the viatical settlement company says, oh, I just got I just paid $5,000 for a $100,000 asset. I'm going to sell it to a bank. And the bank says, that's worth $100,000. I'll give you $10,000 for it. So the viatical settlement company doubles their money. The person who had the underlying account made some money, and the bank is going to make 90%. It's pretty strong. Where they're going to pay $10,000 to actually have a what is that? 900% gain when they actually cash the thing in. So that's what a viatical settlement company does. That's why it has value. And that's why if it has value to a bank and it has value to businesses, it has value to you. So if I'm taking that $1,000 payment and I'm paying my whole life with my term rider, and the balance, the majority of the money I'm spending is going directly into cash growth, what did I just do? Boom. I took the money away from the bank that was making money with my money every night, and now I'm making money with my money. Why? I'm earning a guaranteed interest rate. It's in my contract. They're going to pay me 3, 4, 5%, whatever the guarantee is. Sometimes, most of the time, if it's a mutual company, then I'm also going to earn a dividend because as a mutual company, I'm a stockholder the minute I have life insurance. So I get paid not only a guaranteed interest rate, I also get a dividend. The dividend is based on how well the company did. I want the company to do well. So not only do I get paid a dividend when the company does well, I'm a walking, talking billboard for that company because I want that company to do well because I'm a stockholder. So now I've moved the money that the bank was making money every night with, and I wasn't getting paid anything. And now I've moved it into a situation where I'm getting a legacy for my family. I'm getting cash growth. I'm participating with the company that's holding the money, and I can use the money anytime for any reason. I don't have to ask anybody. If I want to use it for retirement and I want to retire at 45 years old, I can. And the bank won't tell me no. The IRS can't tell me no. The only person who tells me no is me or my wife. And that's how that works. So now I've got that money. And now let's say I want to exercise my ability to leverage some of the money in my account. And I want to pay off my car that I now owe $1,000 for. So rather than me stroking a check for $1,000 of my own cash, spending the dollar only one time, I'm going to put that $1,000 into my infinite bank. I'm going to let it sit there for a half a minute, and then I'm going to take a loan. I'm going to take a loan against that $1,000. The $1,000 is still in there. I'm still earning interest and I'm still earning a dividend. And now I also have the $1,000 in my hand because the loan just came through. What did I just do? I just increased my net wealth. I've still got my $1,000. It's still earning interest. It's still earning a dividend. And now I have $1,000 cash that's in my checking account, which I'm now going to send and pay off my car. I'm going to trade that $1,000 of cash for $1,000 of equity. What did I really do? I traded the carrier's $1,000 of cash for equity in the car that I now have. I have $1,000 of my own money earning interest in a dividend, and I have $1,000 of equity. And I did this with a starting amount of $1,000 from my original checking account. I just doubled my net wealth. And you can do this over and over and over again. And you should. This is something that we do here. So now I make that $1,000. I take the loan, goes back into my checking account. I tell my carrier, my bank to send the money to the creditor, pay off the car, and get the deed back. This is a much better way to spend money than spending it only one time using your current model. So in the end, what this is all about, this is about spending and saving money more efficiently. It's about being smarter with your money. It's about not doing things the way that's the best for the banks. It's about doing things the way that's best for you. All right. So if you want to see what it looks like in practice, go back and watch any of the other videos. There's tons of them out there. It's the same two clients that I've used for years, one of which at this point is now completely out of debt, having eliminated what was almost $800,000 of debt in about 4.5 years using the system. All right. So that's the end of the beginning. And now we're going to go ahead and open it up. Let's see. Does anybody have any questions? Let's all do the Andy Grieg. It's time for us to go get crab cakes, sir. For those of you that don't know, you're in the presence of royalty. Andy Grieg is the #1 metallurgist in the world. He's the guy that everybody wants to talk to about how to put anything together with metal, including all the shipyards and the U.S. Navy. He's the man. Hi, Andy.
Hi
Did I
there.
did I edify you appropriately?
Uh, Perhaps a little hyperbolic.
Okay.
But
Number one, #1 metallurgist in your hearts, top metallurgist in the world. Is that better?
I'll use the definition of an expert.
Okay.
An expert is someone in the room who knows more about a topic than anyone else.
All
So
right,
in this
folks.
room of
It's the
six,
Ron Swanson of metallurgy. Anybody catch that reference?
correct.
Okay.
Yes, that was nice.
Question for you.
Answer. It might even be correct.
How much money? So you put in paid up additions, you have a cash value. You have loans against that cash value.
Sure.
How much money should you be using to retire that loan?
Okay. So it depends. Good question. I can't give you a definitive answer, but I can give you some of the metrics that go into making that determination. #1, the underlying health of the insured, because the underwriting does affect the efficiency of the money within the system. First thing. Second thing, the expected retirement age of the individual. At what point do I feel like I'm going to want to start pulling money from the program as income and not making payments anymore? I want to put the thing on automatic pilot. Okay, because that's what's called an RPU, reduced paid up. And we can do that with these programs, unless it's an IUL. If it's an IUL, you're out of luck. Okay. And then the third thing that we look at is what is the return based on when the contract was struck. So depending on what year the contract was issued, there can be a great difference in the the guaranteed interest rate. Okay. And it can vary by as much as 25%. It's huge. Okay, so it just depends on when that. So, and I'll use a modern example. So if you are someone who's in their 50s to 65 years old, and that's when you start your program, and you dump a bunch of money into it. Let's say you put 100 grand into it. Okay, so you're gonna get credit for 100 grand immediately. It's going to earn interest for you forever. There's a number that changes every year, and that's the loan cost. Okay, so the loan cost, I've seen it as low as 3.2%. I've seen it as high as 5.7%. So right now, with that one particular company, the loan interest rate is 5.11%. Okay, so
And just went down.
if I got in a couple years ago at the 4% not mark, and I'm now making loans at 5.11%. That means my net cost of money, my delta is 1.11%.
Which is very attractive.
Yep. And now I get out my trusty calculator to answer your question because I can't do the math in my head. So if I've got 5.11% paying out, 4%, but and not even considering what the dividend is, but 4% coming in, my delta is 1.11. So here's where we do. So usually the number is somewhere between 50 and 65% is the sweet spot to where the guaranteed interest and the dividend coming in is equal to the loan interest being paid. So in this case, this is a sweet one, so it's probably going to be a little bit different. So let's say $100,000, 100,000. So if I have 100,000, I'm going to earn 4,000. So where is $4,000 equal to my loan cost? So $4,000 divided by 0.0511 is, so the answer is 78,000. So in that example, the sweet spot for that loan is $78,000. At $78,000 loan, the guaranteed interest and the dividend coming in every year is greater than the loan interest I'm paying on that money, which means I can increase, in this example, my net wealth 72%. If my total net wealth is $100,000, I can increase my net wealth $72,000 overnight for free because I'm earning dividend and interest. And I took a loan. The dividend and interest is paying a loan, and now I still have that 72,000. I've still got $100,000 over here, plus all the death benefit that's the legacy for my family. That will continue to grow every year, 3%, 4%, 5%, whatever the contract says. And now I've got this other 72,000. And that's where the duplication strategies come into play. And we start looking at other assets, derivative annuities being one of them, another infinite bank, a daisy chain style infinite bank. Maybe we go into some of the more esoteric things. We start looking at like REIT investments, or maybe we don't do this, folks, unless you test it. Some crypto. Okay, so there, just this is not about crypto. Okay, don't if you want to talk about crypto, give me a call. We'll talk about it. But so this is one of those things that I have to be careful about what I say because this is going to go out on the web, and I just want people to be careful. Okay, this is not. I'm not giving you financial advice. There you go. Now I'm protected. All right. So that's the sweet spot. I think that answers the question that you're looking at, and then it looks at what else do we do? What about the duplication strategies? Okay, well, what do you want to do? When do you want to have the money? How much money do you need? What is the purpose of the money? And then there's tools that you can use investing in other non-taxable strategies, or maybe using that money to, this is an interesting one, use that money to purchase an asset that gives you a tax write-off. Like here's one, ding, ding, ding. What happens? Let's say you owe $70,000 in taxes, Andy, and you need to pay those $70,000 in taxes in April, Andy. What happens if you take, I don't know, $15,000, Andy, and make a charitable contribution to a specific charity that gives you a 5-to-1 return, Andy? So all of a sudden you just wrote off 5 times 15. What's that? 75,000? Oh, that's coincidental. Now you don't owe the $75,000 in taxes. There are ways that you can do these things.
Never heard of the 5 times the gift.
So this is Mr.
That's
Grieve. You and I have a conversation that's getting ready to come up in a couple weeks.
Yeah.
This is the stuff you're going to learn about.
Okay, cool.
All right. So yeah, so there's lots of stuff out there. Most of the time, people don't know about them, and it's you can talk and talk and talk and talk and learn some stuff, but there's no easy way to learn other than just being present and come to stuff like this, watching videos, um, listen to people that are in theory reputable.
Hey Scott, can
Hey,
you can
Mr.
you
Kent,
use money from a 401k to
is your
fund?
name Clark?
I never heard that before.
Sure. All right,
Okay,
your question is, can you use money from a 401k?
to fund this type of an insurance arrangement?
Sure, as long as you pay tax on that money after it comes out of your 401k.
Tax on it, you can't do any kind of an
You
exchange.
can't, no, there is no such thing as a transfer of not of taxable money in a retirement program into a non-taxable life insurance program. It doesn't exist.
I thought there was some type of exchange you could do, but no, that's not.
No, you're thinking of a 1035 exchange, which can be done, but that's life insurance cash value to life insurance. You can't
Okay.
go 401k, 403b. You can't go any retirement program into life insurance.
You can use, okay, but you'd have, all right, I got you.
You're going to have to receive the funds and pay tax on it first.
Well,
Which,
yeah,
in the end, that's not a bad deal either. Because
well,
what you're doing is you're trading a
yeah,
taxable growth vehicle for a non-tax vehicle that's going to leave a bigger legacy for your family. The legacy is going to that you leave with a life insurance policy is going to be multiples of the cash value that you put in there. Whereas the legacy that you leave with a 401 is just the value of the 401. There's no additional death benefit.
right. Well, that's my thought on it is,
The
yeah,
other alternative is a taxable IRA, 1035, sorry, taxable annuity
right.
exchange.
And there's a non-taxable annuity also, which is one of my favorite tools. And we happen to be in that season right this minute until March the 30th. For those of you that are interested, that's called a Roth IRA or a Roth annuity.
But
You can
you have to put in unqualified money.
correct. Yep. You have to put in non-qualified, already paid the tax on the money. The same thing you have to do with a traditional Roth. Can't start a traditional Roth with pre-tax dollars. Okay. Anybody else have a question? That was a good one. Thanks, Clark. Mr. Kent, where are you? I know we established that your picture is in Ireland, but where are you physically?
Uh, outside of Chicago,
Oh,
suburb of Chicago.
okay.
Yeah, I'm fairly new. I report, George and Janet are my upline.
They are my mentors.
Yeah, yes, I know. I've seen you
They're
and
great
heard
people.
you talk. But I'm about 3 months into this, maybe a little less than that.
They're nice.
Just learning, but this is very interesting stuff to talk to people. You know, you got to have other things to talk to people about,
Sure.
besides just life insurance and mortgage protection and so on.
Right on.
I have a question.
I might have an answer.
Who would you say is qualified for this? Because I know they have to, their health is obviously going to be something because you some insurance. So
That's
who would
really
you
the only
say
restriction is health.
okay.
Can anybody use this? Yeah. You in theory, you can write these programs on people between the ages of 18 and 75. And then health. But the problem is with the older clients, that 70 to 75 range, there's only one carrier that you can cover them with. And that carrier has a very high minimum death benefit, which means that, if you've got a limited budget, 200 or 300 bucks, you're going to barely cover the cost of life insurance and you're not going to have any cash growth. So, if you're doing it for cash growth and you're over 70, there's other solutions that we should be looking at. This isn't the one, or at least that one isn't the one. Okay. So, one of the biggest questions I get about who's appropriate for this with debt wise, I've heard people erroneously say that people that only have a mortgage aren't eligible. And I say they're wrong. Absolutely. Just a mortgage, they're certainly eligible. If I can pay a 30-year mortgage off in 15 years, which is what these will do, sign me up. Because in the process of paying that 30-year mortgage off, if the mortgage is 300 grand, the byproduct of these programs is that we capture usually about 60% of whatever the debt load is as cash value. So if we have a $300,000 mortgage and we're using an infinite bank to pay it off, and we capture 60%, that's 180 grand. So you can make extra payments and double up and do that and pay it off normally in 15 years, or you can use an infinite bank to do the same thing, pay it off in 15 years, and have $180,000 cash in your program. Which one's better? It's a no-brainer. Andy, I
So
saw
that
you.
way, a young couple in their first house.
One more time.
So that's why it could make sense for a young couple in their first house.
It makes sense for anybody with any debt. So a young couple, over 18 years old, buying their first home, whether they're buying their first home or their 50th home, it doesn't matter. It's just do they have debt? And if the answer to that question is yes, then it is a no-brainer. They should look at this. They may not be eligible for it because then maybe they don't have the money for it. You can't do this on $10 a month. But that's why when we look at structuring these programs, we ask a ton of financial questions and we get down to the nitty-gritty. How many times a week do you go to Starbucks? Okay. We're gonna cut that down to 2. You don't need Starbucks every day. They got plenty of money. Okay. Get your caffeine at home. I'll buy you a coffee pot. Okay. So that's why
So
we have
my
to ask those
question,
questions. I'm sorry?
my question would be if they don't have debt, like their home's paid
Right.
off, we don't have credit.
Bravo. What does that mean? This is a financial instrument that works in phases: maximization, accumulation, distribution. That means they're starting off in the accumulation phase. Hell yeah. Let's start doubling money immediately.
Okay,
Then this isn't a debt-free life bank. That's a pure infinite bank.
okay, so okay,
Okay.
that makes sense.
That's a good question though. Thank you. Did I say hell yeah? I think I said hell yeah, right? Yeah, I did. Did I say hell yeah, Scott Simpkin? Ooh, don't wreck. Ooh.
I do believe you did.
All right, thank you. Thank you for that confirmation. All right. Again, anybody else with questions?
Hey, Scott,
Yes, sir.
John here.
Hey, John
Uh,
here.
I want to thank Scott for getting me the invite to this. I got certified DFL a couple months ago, and I've sat through multiple Scott Simpkin presentations.
Awesome.
So he's shown me a lot. The question that you posed, though, you get somebody in their 70, 75. I've shown a couple clients a one pay or a two pay that kind of makes sense because they can put 50 or 100, in. And that immediately generates a death benefit. And then, in 3 or 4 or 5 years, they've broken even, so to speak. They already paid tax on the money they put in. Now they're generating money tax free if used properly. So, what other scenarios are there for people that maybe don't have the good health and
You got a
the
kid?
cost of insurance is gonna be so much, it won't really allow them to build any
They got a
cash flow.
kid?
Pardon me?
Child,
Yeah, write it on the child.
aunt, uncle, brother, mother,
Yeah, yeah,
father,
okay.
sister, some
Yep.
other family member that they have an insurable interest in that's healthier than they are.
Yeah, got it. Okay, that's what I thought, but I just wanted to see if there was some other
Yeah.
approach you were
And
thinking.
right now, if that only person, like I have a client right now I'm working with, he has only one person in his life. His parents are passed. He's an only child, doesn't have any cousins that he's tight with. He's got an ex-wife and one child. That's it. So the only other person in his life that he has an insurable interest in is his 12-year-old daughter. What do you do? Well, you write it on the 12-year-old daughter with a different company. That company's called a surety.
Yeah, that helps a lot. Appreciate that. Scott and I have had a couple situations where the original client didn't pass muster due to
Sure.
health considerations. So we put it on the wife who did pass muster, and actually the cost of insurance for the wife was less. So the piggy bank
Sure.
actually generated more money.
Yep.
So yeah,
It
thank you.
doesn't mean you ignore the target though.
Yeah, of course.
If part of the conversation was death benefit, you still write the death benefit. You know, if they've got a total of 300 or $400 for the premium to work with, then if the concern is that my husband doesn't have any life insurance, his health is not good, I don't have enough money to bury him, much less afford to pay the house off.
Right.
Okay. So you do an infinite bank on the wife and you do a pure whole life, even if guaranteed issue if you have to, death benefit on the husband. You get something there so that there's at least, 6 months or a year of coverage of mortgage so that the wife doesn't have to worry when
Yeah.
husband passes that she has to sell the house immediately or get foreclosed on. Give
Yeah,
her some
good point.
breathing room. Don't always remember what's the original concern? What's the original why? Why are we talking? Is the only reason we're talking to eliminate death benefit, or do you have a concern for something else? Or to eliminate debt? So always get to the why.
Great counsel.
Okay. Anybody else? Hey, did you folks hear that Laureen Williams wrote her first policies today on a brand new client from a standard request? Congratulations, Laureen. Wait, did she do layering on that client? I believe she did. Congratulations, Lori. You mean she wrote an accidental and a term with all the living benefits? Yes, she did. Congratulations, Lori.
Thank you, Scott.
Right on. I remember that. I remember when you did that, Dulce. That wasn't that long ago. Right on. All right.
I was focused on my product placement.
Yeah. Right. There you go. See that? Forehand agency, love it. Right on. It's all about branding. Okay. Does anybody else have any questions? Or are you freeing me up to for me to go eat my lime and cilantro encrusted tilapia that I'm having for dinner?
Sure, I have one question.
I might have an answer.
Okay. So I have a few family members who the debt-free life program would make sense for.
Okay.
My question would be, because they had a few questions about it, how soon can they start utilizing it once they start paying their, premiums into it?
One day.
Oh, so they can utilize it like right away after they.
Yeah, I mean, if you start and you make your first premium and it's $100,
Hmm.
and you have structured $10 to go into cash value, can you use it the next day? Yes. How much cash value is in there? $10. So
Yeah,
I don't know how far you're going to go with $10, but yes,
right.
you can start using the program immediately afterwards. And we now have a new instant decision DFL
Hmm.
that we just beta tested. And I think I wrote two of them. And within about less than 8 minutes, the thing was underwritten, approved, and issued.
Nice.
I'd like to
Yep.
know about that.
Say again?
I would love to know about that.
You'll hear about it. They'll be releasing it soon. Okay. Anybody else? Well, folks, thank you for joining me on this 46-degree, partly cloudy evening, Thursday evening in January. For those of you that will be at the Align conference, can't wait to see you. That'll be in a few short weeks away. If any of you are going to Tamarindo, Mexico next week, I'll see you there. Everybody else, thanks for coming. Hope you got something out of this, and be well. If you get a chance to go to my YouTube channel, go ahead and what is the thing? Where you click? I don't know. It's whatever when you so that you get the updates when they come out. Okay. Appreciate everybody. Bye.
We've got